Spencer, it seems to me like we're in this weird space of a shifting tension between supply and demand. So many places have been supply constrained, and now perhaps as supply is starting to loosen up, we're wondering if demand is getting soft. What are you watching in that balance?
Well, I mean, as it relates to ad tech, demand has been destroyed. I mean, we saw Snap and Twitter with terrible results last week. Obviously, Snap's stock price tanked. Twitter held up thanks to the deal that's in place. To give you a sense of just how much advertising demand fell off a cliff at Snap, they saw just 13% year-over-year revenue growth, which was a deceleration from 38% year-over-year revenue growth the prior quarter. And worse still, they announced that the first couple weeks of this quarter, they're seeing revenue down 30% year-over-year. So talk about demand falling off a cliff. That's a huge problem. What's happening in ad tech on the demand side is this macro meltdown of the last few months, which shut the IPO window and shut the late stage growth window. That's impacting advertising spending, and not just spending on advertising, spending on hardware and all sorts of, SaaS revenue, other things that are reporting this week. So just in my personal portfolio, for example, of about 100 venture funded companies, I've seen one reduce ad spend from 300 million to 75 million, one reduce ad spend from 80 million to 40 million, one reduce ad spend from 10 million to nothing. So a lot of the late stage growth venture capital, which ordinarily would fund digital advertising on Snap, Twitter, Google, Facebook, et cetera, that is gone, and companies are cutting back.
So, Spencer, who's right? And between the companies in your portfolio and the consumer, right? Because we were just hearing from a bunch of banks, boy, maybe the consumer should feel like they're in rough shape, or the sentiment has tailed off a bit, but boy, they're still spending. They're spending down their savings. They're putting some stuff on credit cards. The businesses aren't doing that. They're cutting their marketing budgets, their ad spend. It seems like if they expected the consumer to keep spending, they would be spending advertising dollars to chase those dollars. So are businesses seeing something that consumers don't, or are businesses being overly cautious?
Well, what you have to remember in that loop is burn. So a lot of these companies, even some of the big tech companies, they burn cash, or they don't have that much cash flow. So they're reliant on the funding cycle to continue funding headcount growth, marketing spend growth, other expense growth. So you look at Twitter, for example, 47% year-over-year growth in R&D expense, in basically headcount expense, and yet revenue was just crushed. So that's unsustainable. If you're Twitter, you are absolutely going to have to cut back more on expense, whether it's your own advertising or your own headcount, because there's no capital available to you. And on the private side, it's even worse because the late stage growth market is shut. The IPO window has been closed for 6 months. It'll probably be closed for another 6 to 12 months. So without capital to fund those investments, those companies have no choice but to cut back, unlike consumers who can keep spending, at least for a while, on credit.
Hey, Spencer, on housing, I know we've talked a lot about the reset that's taken place across the sector, up and down the chain. Although the street, it appears, is pretty confident that one way or another, the Fed's going to get inflation back under control. Do you think enough damage has been done, or are we just getting started?
Well, I mean, there is optimism in the market that maybe the Fed, I think another 75, maybe 100 this week, that we're already starting to see the impact of the Fed rate increases. You are seeing housing coming down. You are seeing the price of oil come down. And generally, there's optimism that in 2023, the Fed rate increases can finally stop. As it relates to housing, this supply-demand imbalance is rapidly coming into order because demand in housing has fallen off a cliff as mortgage rates have gone up. And that's why you're seeing all of a sudden homes start to sit for a while on the market, and you're starting to see home values start to flatten, and in some markets actually decrease. So supply and demand is starting to come into balance, but housing has this huge problem, which is really unique to the housing sector of the economy, which is just a lack of supply, that home builders haven't built enough houses coming out of the 2008 financial crisis. And so even though demand has declined, we just still don't have enough homes for people. So housing affordability is terrible as mortgage rates have gone up, but we need more houses. We need builders to build more.